Hi, good morning. Good morning, everyone. My name is Jillian McIntyre, and I'm with 221B. I'm the founder and managing partner of 221B. I'm sure half of you in the room are thinking, what the heck is that? Well, the reference is Sherlock Holmes, who resided at 221B Baker Street. To be a good short seller, I think you have to be inquisitive. I think you have to be an independent thinker. And you have to have a healthy dose of cynicism. Who better than a detective from my hometown of London? We've been around since 2014, and we are primarily short sellers, but we do invest in longs, and we typically look for those that get bought. Sorry, I'm going to put the disclaimers up here for a second. So given the nature of the conference, before I get on to my very actionable idea, I wanted to give you a little bit more information about us, and I'll be brief in the interest of time. At the end of the presentation, I'll provide my contact information if you want to get a copy of a case study. We may oblige. We typically give it only to our investors or under strict NDA. We are a fundamental long-short equity event-driven fund. Our differentiation is our short ideas, and I'll get onto our philosophy there in a moment. Since the inception, we've been running at about 20% net short, and on average, we've made money every year, except one, and alpha every year. So we typically find between 3 to 5 high-conviction, event-driven ideas. And we look across the globe, but we tend to focus on regions that have very poor corporate governance. That would include countries like Germany, remember Steinhoff, Avanti in the UK, but also places like South Africa and Australia. Apologies if you come from any of those countries. So if I focus on the 5 M's, this is our own philosophy. You've probably heard of the 4 F's. Well, we like to think of the 5 M's, and this is how we approach short selling. So the first of the 5 M's is management, or as Carson put it, scummy management teams. Second is mendacity. That really focuses on SEC correspondence, accounting irregularities, bad behavior all around. Model is on a poor business model. Mania is really regarding the valuation, and mediocrity, is it consensus or not? If a company has mendacity, believe me, we will size up. I focused on shorting while I was working for Chris Hahn of the Children's Fund. More recently, I've partnered with an activist short seller, and I'd like to credit the team for helping me put together this presentation. You see, I was planning to present a different idea, but I couldn't resist the 300% move in this stock year to date. So that got me really, really excited. I'd also like to mention Andy Pipper, who brought it to my attention. The idea is Intelsat. Intelsat has 50% downside, in our opinion. The company is on its highs for the past 2 years, and it only has 7% short interest. Let's do the basic math here. Company has 14 billion of debt, market cap of 1.4. It has a $1 billion run rate of interest to pay every year. It has negative cash flow. Show of hands, does anyone seem interested in owning a company like that? And that question is not for any distressed investors in the room. If you're a distressed investor, you cannot answer that question. It really is not rocket science. So if I can leave you with 5 points to take away from this presentation, we believe Intelsat is a company that's highly levered, has negative cash flow, it's ripe for technology disruption, it has a very bad business model, and there is immediate need for a capital raise. So what does the company do? It's in the satellite communication space. It provides signal broadcasting to major networks, government, and media companies. And most of the market share is in places that have historically been undercovered, like Africa and Latin America. When I was doing the work on this, there were some very distinct similarities with SunEdison. Now, you may ask, SunEdison is a solar company. What's that got to do with a satellite company? It's the level of indebtedness, their bad business model. We were very contrarian on SunEdison, pitching that back in 2015 as a short at $30. It went bankrupt about 6 months later, which was actually faster than we expected. So when we put together our case studies, we like to think about the stages of the short. That really helps us to think about the management, what the management might do, and how they would react to a worst-case situation. It also helps us consider the sizing in the portfolio. In the case of Intelsat, we're in stage 3 of 8. We saw how the company lured investors into buying the IPO at $25 and how it's generated compound rates of return of -4%. The lack of financial discipline has led to significant leverage, $14 billion of debt, forcing the company to be a serial debt restructurer. Then came 5G. And that's the reason we are talking about Intelsat today. You may or may not have heard that there's a big spectrum auction coming up in November this year. Well, we're seeing irrational exuberance all over again. And believe me, I went through the year 2000, so I have seen it firsthand. Intelsat is the best performing TMT stock year to date, up about 300%. Yep, you heard that right, 300%. So if you own it, congratulations. But now's the time, and I quote an employee on Glassdoor, it's time to run for the hills. While the sell side thinks it makes sense to discount a win of the auction, I prefer to think about whether the company will actually make it to the auction in November. In the interim, as in stage 4, the company is going to see significant disruption to its outdated satellites. For sure, they're going to try and fix the balance sheet, or the FCC will get them to partner with someone. The model remains significantly under pressure, and even the accounting, I question, as it relates to some bad debt provisions and its amortization rates. It will, of course, try to partner with someone to compete in newer technology, but I don't think it's in a strong position to negotiate. And we're, of course, talking about OneWeb. So we think that Intelsat exhibits all of the 5 M's. Sorry, just go back here. 5 M's. And we think rather than $13.60 per share, which it hit on Tuesday after earnings, it will see $6.35 first. And I'll get to that later. I'll briefly talk to some of the issues they face. Now, remember, you can focus on the auction like other investors have. Or you can question how the management actually get to the auction without becoming a going concern issue. Intelsat has a very complex debt structure. It's a serial restructure in need of yet another deal. Our credit analysis suggests that it's breached its financial covenants in 2017 as it relates to the Intelsat Jackson Secured Credit Agreement. We think at a minimum, this company needs to raise between $400 to $500 million, which will not even cover the costs that they're likely to incur in the C-band auction. We think in the worst case, it'll actually have to raise somewhere between $1.5 to $2 billion. That's difficult. We don't think they have access to any new revolving credit facilities. So what's got everyone excited? Why has the stock gone from 4 to 11 to 13.60 in the last couple of weeks? Well, according to a dearth of news release suggesting that the FCC wants to move forward with expanding the use of mid-band spectrum from satellite to terrestrial mobile services. Perhaps this is just a sheer coincidence. According to the sell side, the spectrum's worth at least $5 per share, if not more. I like to think of this as let's stick our finger in the air valuation. But not so fast. The C-band auction is expected to start in November, but we have multiple events to get there. And the most optimistic scenario is there'll be a period of at least 12 months to see any monetization of the spectrum. Also, let's not ignore the challenges with C-band. Simply put, Intelsat would need to clear the existing spectrum of incumbents prior to or after the auction, plus approximately $2 billion of finance to build it out. According to one of its former lenders, and I quote, "The reality is that it will be at least 3 years before Intelsat is able to generate any cash from the C-band. 3 years, yet it's being priced in today." So this is why I question, how does Intelsat make it through to the spectrum auction? Aside from its debt, it's facing significant technology disruption. The market's going to be flooded with high-throughput satellites in the next few months. And in the longer term, you'll see the onslaught of what we call LEO satellites. These are low Earth-to-orbit satellites, so they go closer to the Earth than the satellites that Intelsat, the geosatellites that Intelsat is putting into the orbit. That has an immediate impact on latency and other factors. So the LEO satellites are significantly cheaper. The other factor is fiber optic cable has also come down in price. And key markets for Intelsat, like Africa and Latin America, have seen expansion of mobile broadband replacing satellite at a very fast clip. The OneWeb relationship with SoftBank is one way that Intelsat is trying to involve itself in the LEO market. But it's unclear if it's really in that strong a position to negotiate. And we're still waiting to see what the distribution agreements with OneWeb will be like. Oops, sorry. So let's get back to the fundamentals. The company recently reported its Q1. And while the stock started down pre-market 10%, it closed up 33% on the day, despite missing numbers. So to be clear, we're on for one ride here. This will be volatile. We think management has not done the right thing by shareholders in the form of its indebtedness. However, we would suggest that analysts pay close attention to the SEC filings related to clerical errors in their audits. Yes, that's old, but I think it's still significant, and we watch those sort of things quite closely. We also think that the accounting is somewhat aggressive in the form of the bad debt provisions and the amortization rates, and the reliance on future revenue. Remember, this is what took down Avanti Communications in the UK in terms of the reliance on future revenue. So how do we value Intelsat? Oh, sorry. So as the employees have stated here, this is on the way down, or you should run for the hills. So how do we value Intelsat? That's quite tough, given it's not producing earnings. We take our base case on a 6x EV to EBITDA multiple, which is still at a premium to the group. We also assume a 10% risk of bankruptcy if it doesn't refinance its debt by February 2019. So our risk-adjusted price target here is $645. Yeah, that's about 50% downside. In our case studies, we also highlight the pre-mortem, which are sort of basic risks as to where we could be wrong. We think the idea of being wrong here is limited. We question, will they get bought? I would urge any potential buyer here to wait 12 months and they get it for a much cheaper price. So in summary, we think Intelsat fits all of our 5 M's, as I outlined earlier. We're particularly focused on the mendacity. Intelsat is not the worst company we've seen, and believe me, my partner has seen most of them. But we do think investors that have made money should sell, and any that are inclined to short should consider shorting it. As promised, here's my contact information. Thank you very much to Whitney Tilston for having me at the conference.